Welcome to our presentation for International Relations. This is our progress report. We are Sean, Liz, Sam, Alay, Nicole, and Laura. For our product selection, we have chosen to do the Cheesecake Factory. Talking about the situation analysis, the Cheesecake Factory operates 3 brands of full-service restaurants in the upscale casual dining segment and 2 bakery production facilities currently in the United States. Cheesecake Factory has over 160 restaurants and bakeries across the country selling their products and expected to grow to 300 over time. Many of these locations are near shopping malls to capitalize on the flow of customers. Moving on to industry, an overlook at the industry performance shows us that the saturation is occurring in all food service industries. Profit margins are low due to significant price-based competition on menu items. Growth will occur only from garnering market share and revenue from other food service industries. The level of market share concentration in this industry is low. The level of geographic concentration is not expected to change significantly in the near future. From 2008 to 2011, as you see, revenue and net income have increased over time. Projected revenue growing at 4.6% in 2012 to total $55 billion. Based on restaurants, bakery, and corporate, here's the breakdown for revenue and total asset from 2008 to 2010. According to 2010 10K annual report, in the fourth quarter of fiscal 2011, the total revenues were $477.7 million, compared to $416 million in the prior year. The additional week in the fourth quarter of fiscal 2011 contributed approximately $43 million of sales. It leads the industry in sales productivity for popularity of its brand. A quick snapshot for total assets, total liabilities, and stockholders' equity from 2010 to 2011. Here's a look at the market share. What are the company's core competencies and how do they translate into a competitive advantage? The Cheesecake Factory is known for its quality food, excellent service and hospitality, extensive menu catering to several diverse palates, and high-energy settings. The restaurant's distinctive contemporary design and decor create a high-energy, non-chain image and upscale ambiance in a casual setting, making it popular among consumers. The restaurant industry is highly competitive. There are a substantial number of restaurant operators that compete directly and indirectly with the Cheesecake Factory, many of which have significantly greater financial and operational resources, higher revenues, and greater economies of scale than the Cheesecake Factory does. The restaurant business is affected by many factors, including changes in consumer tastes and discretionary spending patterns, macroeconomic conditions, demographic trends, weather conditions, the cost and availability of raw materials, labor and energy, government regulations, and local competitive factors. Any change in these or other related factors could adversely affect restaurant operations. In addition, with improving product offering at fast casual restaurants, quick service restaurants, and grocery stores, consumers may choose to trade down to these alternatives. As a result of these competitive factors, the Cheesecake Factory must constantly evolve and refine the critical elements of their restaurant concepts over time to protect their long-term competitiveness. How is the product positioned? The positioning of the Cheesecake Factory is very smart. It is committed to excellent service and hospitality through the selection, training, and retention of high-quality employees. It gives generous food portions, it's quite affordable, and it offers an extensive and innovative menu, and the locations are very good. What is the competitive environment? The restaurant environment segmentation is broken down into fine dining, casual dining, fast casual, and quick service. The Cheesecake Factory is in the upscale casual dining segment. The competitive landscape for companies in the upscale dining market is strong and intense, with typical restaurants competing for individual patrons. Moving on to establishing international objectives. Expansion of the Cheesecake Factory into a Persian Gulf country should help the company to achieve 3 objectives. First and foremost, any project the company takes on should increase the value of the firm. An expansion that is not profitable over the life of the project should never be undertaken. A short to mid-term goal for the company is to capitalize on its brand recognition. Companies that enjoy international brand name recognition should have an advantage in attracting new customers overseas. The third objective of international expansion is to gain a presence in countries where the target market is experiencing high growth. This is a long-term objective as the Persian Gulf region grows as a financial hub. The Cheesecake Factory has a highly successful domestic business model that effectively generates profits from upper middle-class consumers. In the U.S., the Cheesecake Factory operates in 36 states, and each store generates an average of $10 million in annual revenue, the highest in the industry. Much of the reason the domestic model has been so successful is the careful choice of venues where the company places its restaurants. Cheesecake Factory restaurants are normally located in upscale shopping areas that attract upper-income consumers. While this strategy has been successful, it limits their domestic growth prospects. Simply put, there are only so many domestic locations that fit the Cheesecake Factory profile. International expansion will allow the company to locate similar untapped locations overseas. Countries like Kuwait and Dubai have been centers of commerce and financial activity. They attract foreign business people who match the Cheesecake Factory's target market. As additional benefit of an expansion into the oil-producing Persian Gulf region is that the economy of many of the countries in that area are counter-cyclical to the U.S. Normally, when oil prices rise, oil-producing countries in the Persian Gulf see a rise in revenues. The U.S. economy is normally slowed down by higher oil prices. As such, expansion into the Persian Gulf region should help to diversify the company's revenue stream. The Cheesecake Factory should benefit from the name recognition it enjoys overseas. In general, global tastes are becoming homogenized as the forces of globalization push consumers toward a set of common likes and dislikes. Marketing studies have demonstrated that many foreign visitors to the U.S. make a point to visit a Cheesecake Factory restaurant during their stay. Expansion into the Persian Gulf will make the restaurant available to a much larger crowd of foreign travelers than those who have the opportunity to visit the U.S. While the company should consider all modes of entry, the political instability in the region make it desirable to minimize capital investments and provide a relatively quick, inexpensive exit. This consideration may make licensing, a strategic alliance, possibly a joint venture, preferable to other modes of entry. While these modes of entry provide flexibility, they also limit the amount of control the company will have over its brand. It is critical that the company protect its branding and image so that the visitor experience lives up to the reputation the company has built in the U.S. Another key to success will be adapting the menu selections to local preferences. Fortunately, this is a core competency of the company. Again, the company must strike a balance between providing customers with the Cheesecake Factory experience and adapting to local preference. Finally, the company should move slowly and be cautious not to threaten domestic operations with the international expansion. Cheesecake Factory currently has $80 million in cash on its balance sheet. While this is probably more than adequate for domestic operations, making a large foreign direct investment could drain the company's cash position. This can make it difficult or impossible for the company to weather periods of reduced domestic revenue. Overall, the Persian Gulf provides the company with an opportunity to operate in their preferred location. Looking first at the country level, we have listed some basic facts for you to reference. However, we would like to highlight a couple of these for you. U.A.E. appears to have a steady rate of GDP growth. Its income per capita is also much higher than other countries in the area. However, we recognize this cannot be a final determinant given the disparity of income between the upper and lower class. On this note, the unemployment rate is relatively low, which may be one signal of less disparity between the two classes. As for political risks in the market, most land is government-owned and the ruling families exercise considerable influence on the judiciary branch. However, as of 2010, non-citizens were given the right to own, buy, sell, rent, and mortgage property, as well as invest in special areas. U.A.E. has no income tax and no federal-level corporate tax. However, there are different corporate tax rates for certain activities. There is no general sales tax, and the overall tax burden is quite low. It is also important to note that political corruption is present at modest levels. In regard to market potential, there is no minimum capital requirement for establishing a business, and the process is much quicker than in most areas of the world. Employment regulations are fairly flexible, but the non-salary cost of employing a worker is moderate.